I think Bitcoin is more cheap right now, whereas earlier last year, like in kind of the mid 2025, that's when you had kind of the treasury companies getting really high MNAVs. That was kind of Bitcoin's semi-euphoric moment, whereas now it's more bearish. But I'm still structurally bullish on it. The part of the market that I think is fundamentally changing is the broader crypto space, which outside of Bitcoins and stablecoins, I've been structurally pretty bearish on. And I think that is kind of finally that's becoming more common knowledge, which is that the broader crypto space is, Bitcoin's been around for 17 years, and it's structurally grown. It's made higher highs over time. Stable coins have structurally grown. Everything else kind of explored all these narratives, and didn't really build a sizable market. I think that the broader altcoin space is more in a persistent stagnation now, meaning it doesn't go away overnight. And there's still marginal use cases outside of Bitcoin stablecoins, but I think those are fundamentally very small.
Lyn Alden begins from a sober premise. Bitcoin is still a small asset in the global financial system, and because of that, it does not yet behave like a mature monetary anchor. Instead, it trades like a high-volatility risk asset, closely linked to speculative sectors of the equity market. This distinction is critical for understanding recent price action, both in Bitcoin and across the broader crypto ecosystem. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Bitcoin is still a much smaller asset, and so it trades more like a risk asset. Lately, if you overlay software as a service stocks, so not the NASDAQ itself, which is a mix of stocks, but specifically like the software sector. If you overlay like a software ETF with Bitcoin, it's almost the same chart, somewhat different magnitudes because Bitcoin is more volatile. But they've both been sharply selling off. They previously rose together. So Bitcoin is heavily being traded like an AI play, whether it's the algorithms getting in, whether it's funds getting in. Kind of see the rise of AI and kind of the kind of combined sell-off of software and Bitcoin. So I think, yeah, those are fairly decoupled at the moment. I think Bitcoin is more cheap right now, whereas earlier last year, like in kind of the mid 2025, that's when you had kind of the treasury companies getting really high MNAVs. That was kind of Bitcoin's semi-euphoric moment, whereas now it's more bearish. But I'm still structurally bullish on it. The part of the market that I think is fundamentally changing is the broader crypto space, which outside of Bitcoins and stablecoins, I've been structurally pretty bearish on. And I think that is kind of finally that's becoming more common knowledge, which is that the broader crypto space is, Bitcoin's been around for 17 years, and it's structurally grown. It's made higher highs over time. Stable coins have structurally grown. Everything else kind of explored all these narratives, and didn't really build a sizable market. And some of us have been arguing that it was never going to build a sizable argument. And then as they kind of went through the narratives, they've kind of gotten to the bottom of the barrel ones, like meme coins, for example. It's just kind of more like financial nihilism, where they kind of just admit there's no fundamentals. And so I think that the broader altcoin space is more in a persistent stagnation now, meaning it doesn't go away overnight. And there's still marginal use cases outside of Bitcoin stablecoins, but I think those are fundamentally very small, and that there is overhang in that whole space. There is cross ownership between all those assets in Bitcoin. Obviously, whenever the whole altcoin space has issues, the media will conflate Bitcoin with altcoins, even though I would say fundamentally they're quite different. So I am quite bearish on the broad altcoin space. I would say primarily on the periphery. And again, there's like core cause, and then there's like the actual like last mile, like what caused this particular sell-off. There have been kind of some evidence that a fund in Asia has kind of cross owned some of these assets with leverage, and then when they get kind of blown out of one position, they try to fix it with another position, and then they get eventually blown out of that position. So that seems to potentially have been a cause here. I would say the overall kind of link between gold and crypto is still pretty small. So it is true that, for example, some of the largest stablecoin providers, such as Tether, they have been publicly stacking gold as part of their kind of excess reserves, and then also they've got gold stablecoin products that they've had for, I believe, going back to 2019, 2018, in that kind of time frame. So some of these kind of core products have existed for a while. They've historically not had a ton of demand. So in a world of trillion-dollar market cap Bitcoin, the demand for these kind of gold-backed products was only in the billions. It wasn't particularly attractive. As obviously as the price has risen, they've generally gotten more attractive. But then also when you have an entity like, say, Tether, that has all these stable coins outstanding, so those are effectively liabilities for them, and then they put those in assets of some sort. Now, generally speaking, most of those assets have to be kind of correlated with their liabilities, so they're going to be dollar based. They're going to be T-bills. Before they were kind of like reverse repos and things like that, but basically they are kind of money-like, dollar-like instruments that then earn interest for them, so they get a spread. And so that's kind of the bulk of it. But then they also say, well, we're going to put some percentage of it in Bitcoin, some percentage of it in gold. They've also, that entity's made kind of private, kind of venture or private equity type of bets. So they've got this kind of assortment of other things. So the better the stable coins do, it can kind of feed into those other assets that they like as an entity on their own balance sheet as kind of excess reserves, as well as in their case, gold-backed stablecoins, and there are others like Paxos that have had this as well. So there is some linkage there, and naturally there is people that like having a scarce unit that they can self-custody that can't be frozen like a bank account or things like that. That there is some cross interest there. Sometimes they're enemies, but also there's a big component like myself that has been bullish on say Bitcoin and precious metals. And stable coins, not really the rest of the altcoin space, but I think there's a lot of overlap in interest, but not really a ton of cross connections. And that these connections that do exist, like for example that Tether example, in the grand scheme of how big gold is, that's still a tiny bridge.
While the structural weaknesses of altcoins form the backdrop, Alden points to a more immediate catalyst for the recent sell-off. Evidence suggests that a leveraged fund in Asia held overlapping positions across multiple crypto assets. When losses emerged in one position, capital was pulled from others to meet obligations, creating a cascading liquidation effect.
I mean, I've been in the precious metals positions since 2018. It's been a structural view of mine. And of course, markets tend to have a tendency to both take longer than you think and then happen all at once. And I think that's part of what we've seen is because there's this structural view. So if we kind of first lay the bedrock, I do think that we are entering a more structural world that is more interested in neutral reserve assets. Based on many metrics, the dollar kind of peaked as the global reserve currency in roughly the year 2000, kind of lingering on into the early 2010s. Gold bottomed as basically a reserve asset in tonnage somewhere around 2009. So you had kind of multiple decades of kind of gradual drawdowns in gold tonnage, more of a shift toward the dollar and treasuries. But then after the global financial crisis, we started to get that kind of pendulum, pretty slowly going back in the other direction. And then, more recent events in the past several years, the war in Eastern Europe and the associated kind of freezing of, sovereign assets, as well as the fiscal dominance regime that the U.S. and many other countries are in that I've covered kind of from macro perspective. Like many of these sovereign debt crises are kind of slowly playing out. Demographics crises are slowly playing out. The sovereign ledgers of the big currencies, including the dollar, just not as attractive as they once were on a fundamental standpoint. So we are getting just more structural interest in gold as a reserve asset for these kind of multiple reasons. But then, of course, things can take a very long time. And then when they kind of start to gather momentum, that's when you get, algorithms jump on, retail gets very enthused after having considered it a dead space for a while. And so things can kind of get temporarily overdone. So I would not have guessed that we would have seen, gold and silver hit quite the highs we saw in 2025 and early this year. I'm glad they did. But then it's natural that there's, volatile corrections on the smallest reason, just because a move that goes up that fast has a fragility to it, which gives you some downside risk as well, of course. Reality standpoint, you can compare gold to some other commodities. Whenever you're at record high ratios, obviously you might have more risk. Now, it doesn't mean that, gold being kind of the king of commodities, it is kind of natural that over the course of decades, it might make higher highs relative to other commodities, and historically kind of has. But when you are at like the tip top of that ratio, and particularly if you move from kind of the lower end of that ratio to like the highest end of that ratio, whether it's gold to oil or gold to a basket of commodities or things like that, you are just inherently more at risk for a correction. That you're not just comparing gold to the dollar at that point, you're comparing gold to practically everything else. Or how many gold ounces does it take to buy a median home in America, for example, when that's kind of near the low end. Again, it doesn't mean that can't structurally make new records, because if anything, gold should hold its value better than a physically depreciating house, for example. But when you quickly are kind of near records, that's kind of a risk factor. I would say there's kind of two phases where gold kind of went off, and I think the first one made sense, and I think the second one just kind of a natural course of getting ahead of itself, which is the first one, I would say, is when we truly entered fiscal dominance, which is, normally speaking, when the Fed raises rates as quickly as they did in 2022. And they got to, they eventually got to pretty high real rates. And normally that would really hurt gold. And gold just refused to sell off. And gold even kind of slowly was kind of breaking out in that very hawkish environment. And so did equities. And that I would point to fiscal dominance, which is when a country has so much sovereign debt that, they kind of raise interest rates. And instead of a normal sell-off in assets, what happens is their interest expense blows out so much that the deficits stay very high, and the market kind of loses confidence that the Fed is able to really kind of toggle the money supply as much as they could in the past. And so these things kind of, they historically have a correlation with real interest rates, and then they just stop having that, because you can get to a point where raising rates sometimes doesn't slow down inflation anymore, because it's not from bank lending, it's from monetized fiscal deficits, and higher interest expense just further blows out fiscal deficits. So I think that was kind of the first kind of decoupling, but I think that was a reality-based one. I think that was kind of gold changing a multi-decade pattern based on the pattern itself having a multi-decade change, which we've entered fiscal dominance. The part where it got just kind of, I think, momentum-based and not tied to any kind of near-term fundamentals was over the past, 6 months. If we stretch back maybe 12 months, but I would say especially this past 6 months of no super clear catalyst for why it should be doing this. But then it's kind of making higher highs. It's a very kind of relentless bid. We've still got fairly sluggish money supply growth in the US. We have multiple central banks still doing quantitative tightening. The Fed obviously just shifted away from quantitative tightening toward very gradual balance sheet increases, but you have other central banks still doing quantitative tightening. Money supply growth is not particularly fast in much of the world, some parts more than others. And so when you had kind of gold and silver going up that much, that last leg of it, I had trouble justifying it from a fundamental standpoint. And so that's when it just kind of, the risk flags goes off, and you say, well, I'm not a trader, so I'm not going to try to say where the top is, but just there's a lot more risk than there was, at that point 12 months ago, 24 months ago. And I was kind of warning about that in my research service, for example. It's natural when you've had to move that fast. I mean, obviously, the volatility and movements of this size in precious metals is just mathematically rare. This has happened only a handful of times in kind of the entire history of gold being a decoupled, pricing mechanism than the dollar. So since the early 70s, this type of kind of raging bull market has really only happened twice in the past. It's kind of the third major bull market in these metals, especially gold and silver. Platinum's still been somewhat of a laggard, but gold and silver having that really explosive market. And so it's natural that when you hit those records, they also get crash or kind of crash-like scenarios, at least temporarily. And now, but my view is that I don't think we crash all the way back down to kind of levels that we were at before. I do think that they're wherever they kind of find a bottom. I think it's still too early to tell as the dust kind of settles here. But I do think that this was a more fundamental re-rating up closer to where they should be, even if potentially overshooting it for a period of time, because I think these metals were structurally inexpensive just compared to the risk out there for sovereigns, for individuals that want to hold debasement resistant assets, especially ones that they have the option to custody themselves if they like to. I'm not in the camp that views this as a bubble, even though I'm in the camp that I think temporarily got ahead of itself. So I think, overbought in a trading perspective. I think we got overdone, but potentially slightly from a fundamental standpoint. When you compare, say, gold to, again, any other commodity and the sheer speed that those ratios got there, sure. But when you really zoom out, I think that the correction is likely to not be just round trip the whole thing, because I think the conditions don't really warrant going back to truly undervalued status. And just maybe the dust settles a little bit, and then we see how the traders and investors get in control. So I'm structurally long scarce assets. That can include hard monies. They can also include just high quality equities. Whenever something gets truly euphoric, I try to rotate out of it to something that's underowned. With Japan's situation, for example, because I was somewhat bearish on Japanese financials, somewhat the unintuitive thing I've done is I've been structurally long Japanese equities, in part because Japanese companies are themselves short the yen. So I mean, they take out yen debt. They're basically shorting the yen, and they are scarcer assets themselves. They're sometimes they're commodity companies, sometimes they're industry companies, and they've actually done quite well, including in dollar terms. And I still longer term. I mean, it's somewhat played out by now because I've been in that trade for like 5-6 years. It's partially played out, but I think that still has longer to go. And so I like entities that have some degree of kind of fiat currency debt, and then they're longer other assets, and then as well just owning things like precious metals, Bitcoin, and just various high quality companies. There are occasionally pockets. I mean, I've been over the past year mildly bullish on Latin America. Not many people would have guessed buying Latin American banks in a war of trade, like a year of trade wars, would turn out. But I mean, they've had explosive 2025. And again, maybe some of that trade played out, but I assume that's an under-owned area. So these kind of, I do think that emerging markets in general, they'll have pockets of volatility ahead, especially in a more multipolar world, where you can wake up to kind of crazy headlines. But I think that they are kind of an interesting, like I'm say 5-year bullish on select emerging markets going alongside these other assets.
Lyn Alden's message is not one of alarm, but of realism. Markets are navigating a transition from a unipolar, dollar-centric system toward a more fragmented, multipolar world. In such environments, volatility increases, correlations break, and narratives compete for dominance.